Hello and welcome to this presentation, Futures and Central Counterparty Clearing. In earlier presentations we looked at an example of how a farmer and a manufacturer could come together through the use of a forward contract in order to manage their respective market risk or price risk. However, we realized that in the case of a forward contract they were subject to counterparty risk. That is to say, during the life of the forward contract, what happens if either of the counterparties default on their obligation, either to deliver the underlying asset or hand over the cash. We realized that in order to protect themselves against counterparty risk, they could enter into an agreement with a third party, such as a custodian, who would manage the exposure over time. In this example, we're going to look at how, through the use of another type of derivative known as a futures contract, the farmer and the manufacturer can come together and manage their price risk and counterparty risk, but instead of using two separate counterparties, they're going to use one central counterparty, otherwise known as a clearinghouse. So here we have the arrangement, but unlike the previous presentations, we're going to introduce the role of a broker. So we can see here that the farmer contacts broker A to give an order to sell March futures, and the manufacturer gives an order to buy March futures to their broker called broker B. Let's assume that these brokers work for big banks. The two brokers then will go on to the futures exchange, whether it's open outcry or electronic, and execute the trade on behalf of the respective clients. Now, what happens is that as soon as the trade is done on the system, the trade is transferred to the central clearinghouse for a process known as novation. Now, we're going to assume that broker A and broker B are what's known also, just for simplicity, as clearing members. When clearing members trade with one another on an exchange, they have a legally binding obligation to either deliver or take delivery of the underlying asset. However, through this process of novation, that contract is dissolved. In other words, it's replaced, whereby the clearinghouse becomes the buyer for every seller in the marketplace and the seller for every buyer. So what happens now is that the central counterparty is taking on considerable counterparty risk, and the counterparty, the central counterparty, needs to manage this risk. So in order to do that, what happens is that the two brokers are required to deposit with the clearinghouse two lots of initial margins or deposits. In this example, it's set at, say, $5 per unit. What happens then, just like in previous examples when we looked at forward contracts, we can see how over time the futures price evolves. Now, if futures are traded on an exchange, then it is the responsibility of the exchange each day to publish an end-of-day settlement price. So, originally, the futures contract was struck at $100. Let's suppose that over time we see the prices change as illustrated here from 100 to 106 to 97, 109 and so on, and eventually settle on the last day in the life of the futures contract at 125. So what happens, just like we've seen in the earlier example where we had the two separate custodians collecting monies from the two respective parties, what happens here is that the central counterparty will take $6 from broker A and transfer it to the account of broker B. Then, when the futures price settles at the end of the next day, say at 97, then the difference between 106 and 97 is $9. Here, though, you can see that we've had reverse of fortunes, and what's happening is that the clearinghouse is going to take $9 from broker B and transfer that to the account of broker A. Now, of course, let's not forget that broker A and B are acting on behalf of their clients, so in turn, they will be paying and receiving these margins to and from their respective clients. So in a way, really what the clearinghouse is doing is taking monies from one clearing member, broker B for example, and transferring to clearing member A or broker A. If we continue with the example, we can see here that the price continues, let's say from 97 to 109, and that's a movement of $12. As we go through time, monies will continue to go backwards and forwards on a daily basis between the central counterparty and the two respective clearing members. Now let's suppose that we get eventually to the last day in the life of the futures contract and the final futures price is published at $125. Now if we were to add up the sum of the positive and negative flows of margin, which we refer to as VM or variation margin, then it's going to come to broker A will have paid away $25 per unit in variation margin, and $25 would have been received by the clearinghouse from broker A. And so at expiry, what happens? Well, what's going to take place now is that the buyer of the futures contract, that is broker B, will now take delivery of the physical underlying asset. And the price they actually pay is what's known as the exchange delivery settlement price. That is the final published price in the life of the futures contract, which in this case is $125. Now, of course, broker B retains the variation margin sum of $25. So if we add up the payment of $125, the retention of the 25 variation margin, then that gives a net payment of $100, which of course relates to the original futures price which was struck at the beginning of the futures contract. By contrast, what we can see with broker A is that they will receive on futures delivery day $125, but they've paid away during the life of the futures contract the $25 in variation margin. So once again, we end up with the net figure of $100, and that's the amount of cash that broker A will receive for delivery of the underlying asset. And at maturity of the futures contract, because there has been no default, the initial margins are returned to the respective brokers. So what we can see here then is how, using a central counterparty, the central counterparty administers the various cash flows on a day-to-day basis and orchestrates settlement at the end of the life of the futures contract. In another presentation, what we're going to do is to look at the additional benefits of the central counterparty, which allows members, clearing members and clients, to be able to net their positions over time. That is to say, they can trade futures contracts in and out during the life, and the clearinghouse will allow these members to net positions over time.